Okay, let's dive right in. Every year, the entire financial world pretty much stops to read one thing: Warren Buffett's letter to Berkshire Hathaway shareholders. You know the one. It's less of an annual report and more of a masterclass in value creation. So today, we're going to deconstruct the 2021 letter and pull out the core principles from one of the greatest investment playbooks ever written.
We have to start with this number because, well, just look at it. It almost stops you in your tracks. From 1964 to 2021, Berkshire's overall gain was over 3.6 million%. You see a number like that, and your first thought is, that's got to be a typo. But it's not. It's real.
So how on earth do you get to a number like that? Well, here's the engine behind it. For 57 years, Berkshire compounded capital at 20.1% per year. Now, the S&P 500, which is a fantastic investment, did about 10.5%. They nearly doubled it. For any of us in this business, that level of sustained outperformance is, it's the holy grail.
So what's the secret sauce here? This isn't some black box algorithm, and it's definitely not a 57-year lucky streak. No, it's a disciplined, clear, and most importantly, a repeatable philosophy. It's a playbook that we can actually open up, study, and learn from.
Here's how we're going to break down that playbook. First, we'll get into the core philosophy. Then, we'll see it in action with what they call the four giants. Next, we'll look at their capital allocation engine. And finally, we'll unpack the enduring advantage that kind of holds it all together.
All right, Section 1. Everything, and I mean everything, starts right here with a fundamental shift in perspective.
This one sentence? This is the bedrock of the entire strategy. It's a world of difference. They're not playing the stock market game, trying to guess which ticker is going to pop next quarter. They are buying pieces of actual, living, breathing businesses. They think like owners, not like traders.
And this is basically their checklist. It's their filter. And notice how simple and business-focused it is. They're looking for a durable advantage, a moat. They want a top-notch CEO. And they're explicitly ignoring the market chatter. For professional investors, this is such a powerful way to cut through all the noise and just focus on what actually creates value over the long haul. Okay, so that's the theory. But what does this business picker mindset look like in the real world? Well, it's embodied in what Buffett calls the four giants, the absolute cornerstones of Berkshire's value.
The first giant is the insurance business, and its superpower is float. Think about it. You pay your insurance premiums up front, but the company might not have to pay out a claim for years. They get to hold and invest that money, that float, for their own benefit. And in 2021, that was $147 billion. It's a massive, long-term source of capital that actually costs less than nothing. It's the fuel for the whole enterprise.
Giant number 2 is Apple. And while most people see this as a huge stock position, Berkshire sees it as owning 5.55% of an extraordinary business. The way they measure the value from that ownership is really the key lesson here.
And this chart just lays out their mindset perfectly. The cash dividends they got, $785 million. Fantastic. But that's not the real prize. The real value is their slice of the earnings that Apple kept to reinvest and grow its business. A staggering $5.6 billion. That's where the real magic of compounding happens.
The third and fourth giants are BNSF Railroad and Berkshire Hathaway Energy. Now, Berkshire owns these businesses outright. They're the critical infrastructure, really the arteries of the American economy, and they just churn out billions in what Buffett calls old-fashioned earnings. No financial engineering, just massive, predictable cash flow.
So owning great businesses that gush cash is step one. That's great, but the crucial part, the thing that separates the good from the truly great, is what you do with all that cash. This is where capital allocation becomes the ultimate competitive sport.
And Buffett gives us a crystal clear, prioritized framework. Path number 1, your first and best option, is to reinvest in the great businesses you already control. If you can't find anything good there, you move to path 2, buy pieces of other great businesses on the stock market. And if both of those options look unattractive, well, then you turn to path number 3. You buy back your own stock. In an environment where valuations are high everywhere you look, repurchasing your own shares at a rational price can be the single most intelligent thing you do with your capital.
And they don't just talk about it, they do it. In 2020 and 2021, when finding attractive deals was tough, Berkshire spent over $51 billion doing one thing: buying back its own stock.
So what was the result? It's simple but powerful. Every single shareholder who held on saw their ownership stake in Apple, BNSF, Geico, all of it, automatically increased by about 10%. They created billions in value just by shrinking the denominator.
But look, the numbers and the strategy are only part of the story. The final piece of this puzzle is, well, it's a bit softer. It's less about spreadsheets and more about the power of people, culture, and even a little bit of serendipity.
The story of the BNSF acquisition is a perfect example. You see, it all started because the owner of a much smaller company, TTI, wanted a permanent, trustworthy home for his business, so he sold it to Berkshire. Years later, that relationship brought the Berkshire board to Fort Worth for a meeting, and it just so happened that BNSF was headquartered there, and it was the height of the financial crisis. 11 days later, they struck a deal. It shows how a reputation as a great partner literally creates its own luck.
This quote gets right to the heart of what might be Berkshire's most powerful and most overlooked advantage. It's not just their strategy, it's the strategy of their shareholders. They have spent decades intentionally cultivating a shareholder base of people who think like owners, not short-term speculators. That stability gives management the freedom to make rational, long-term decisions without having to worry about quarterly earnings calls or a volatile stock price. It creates this incredible virtuous cycle.
So when you boil it all down, the financial genius is undeniable. But the Berkshire playbook really leaves you with a much deeper question. After all the analysis is done, success or failure might just come down to your ability to think like a business owner, to act rationally when others are not, and to simply stay the course. And it makes you wonder, is the most powerful tool we have not our analysis, but our temperament?